Welcome back to Iron Financial. I'm the lead analyst, and my mission today, as it is every single day, is to help you forge a stronger, much more resilient portfolio so you can cut straight through the market weakness. Now let's dive right into this. Right now, we are standing squarely in the middle of what looks like an absolutely unprecedented artificial intelligence semiconductor supercycle. I mean, the heat is on, the hammers are swinging, and massive, unbelievable amounts of capital are being poured into this market. But listen, as investors, we can't just blindly buy into the hype. We have to inspect the structural integrity of the companies we're actually putting our money into. We need to look at the blueprints, we need to verify the materials, and we have to ensure the foundation can actually withstand a market earthquake. So today, we are putting the entire industry and specifically Microchip Technology under the microscope.
And I'm the Market Skeptic. I'm here to represent you, the viewer, and I'm going to be asking the really tough questions today. Because right now, literally everyone is talking about this AI supercycle like it's a guaranteed one-way ticket to the top floor. But I have to ask the obvious question here. Are we actually building a solid foundation, or is this just another fragile, overly inflated bubble that's just waiting to burst at the very first sign of macroeconomic pressure?
Seriously, let's take a step back and look at the broader market context for a second. We have seen these semiconductor cycles boom and bust for decades. The pattern is literally always the exact same. The industry overbuilds based on projected euphoria, demand inevitably starts to cool down, massive inventory piles up in the warehouses, and then the whole structure just comes crashing down, taking retail portfolios right along with it. So, is the AI chip boom truly forging a new permanent era of technological infrastructure, or are we just inflating a glass house that is going to completely shatter when the capital expenditures from big tech inevitably dry up? We desperately need to know if the underlying numbers actually support the narrative, or if we are just buying into a heavily marketed story.
Well, to answer that, we have to go straight to the raw materials. According to the latest 2026 Trends to Watch report from Omdia, the data processing segment's revenue has literally doubled in just 2 years. We are talking about a $200 billion absolute increase since 2023. Listen to me, that is not speculative hype. That is $200 billion of cold, hard cash actually being spent on data center servers, graphics processing units, and power management integrated circuits. To put that kind of money into perspective, $200 billion is roughly the GDP of a small country, and it's being funneled entirely into server racks and raw silicon. This heavy lifting absolutely proves the structural integrity of the AI trend. Major cloud service providers, your Googles, Microsofts, and Amazons, they are pouring concrete and expanding capacity at a truly historic rate because the enterprise demand for AI computing power is just voracious right now.
Now, what is truly compelling here is the long-term forecast from Omdia. They are projecting that the data processing segment might actually exceed a 50% market share of total semiconductor revenue for the first time ever in 2026. Historically, semiconductors have been heavily cyclical. They've been largely driven by the fluctuating demands of consumer electronics, personal computers, and mobile handsets. But Omdia is suggesting this AI boom is fundamentally different. It's fueling a sustained 6-year growth period that could actually break those historical cyclical revenue trends we've all become so used to. We're looking at an 8.6% compound annual growth rate projected all the way through 2029. Okay, hold on. Breaking historical cycles is a massive claim. Whenever someone in finance looks at me and says, "This time is different," my alarm bells immediately start ringing. Sure, the data center might be the strongest pillar right now, but what happens to the rest of the building if that single, massive pillar experiences microfractures or begins to crack under the weight of its own expectations?
Because we really have to look at the specific data points Omdia is putting out there. The advanced chips, the absolute cutting-edge 7nm to 2nm silicon, they are doing all the heaviest lifting here. They're forecast to account for an astounding 59% of total pure-play foundry revenue in 2026. But here's the kicker. They only make up 10% of the actual physical silicon shipments. That is a dangerously narrow base. If 10% of your physical volume is generating 60% of your total revenue, you have a highly unstable, incredibly top-heavy structure. If AI model training slows down even a little bit, or if we hit a wall with government trade restrictions, or if there's a massive supply chain bottleneck at the foundry level, that high revenue pillar could buckle instantly.
All right, let's move into Section 1. Microchip earnings drill down. Forging the numbers. That structural concern you just raised is exactly why we need to move away from the macro blueprint and get down to a micro-level inspection. Let's drill down into the financials of a specific foundational player, Microchip Technology, ticker symbol MCHP. Let's start right at the top line, which is always the ultimate measure of true market demand. Microchip reported $1.311 billion in net sales for the fourth quarter of 2026. Now, context is absolutely everything in this business. Back on February 5th, their own internal guidance projected a high end of $1.260 billion. So they didn't just meet their expectations, they completely blew past the ceiling of their own guidance. CEO Steve Sanghi stated, "This reflects a broad-based improvement across their entire business and meaningful progress from those really challenging inventory correction conditions they were navigating just a few quarters ago."
And the context gets even better when you look backward. That $1.311 billion, that represents a massive 35.1% year-over-year growth compared to the $970.5 million they pulled in during the exact same quarter last year. Let me tell you, when you are a mature, established semiconductor company, posting 35% top-line growth is literally like reinforcing your entire foundation with industrial-grade steel. It shows that customer inventory, which remember had been a massive drag on the entire industry as clients burned through their old stockpiles, has finally fully normalized. They are now seeing improving booking and sell-through trends across almost all of their product lines.
But the most crucial point here is the sequential growth. They were up 10.6% quarter over quarter. Market Skeptic. Wait a second. Why is sequential growth the crucial point here? That year-over-year number looks way more impressive on a headline, because sequential growth proves that the momentum is building right now. It's not just a favorable comparison to a weak, highly depressed quarter a year ago. A 10.6% jump from the immediate prior quarter means the furnaces are burning hotter today than they were yesterday. It validates the execution of their 9-point recovery plan in real time, showing actual, tangible, week-by-week demand scaling up.
All right, let me stop you right there, because it is time for an earnings autopsy. The discrepancies between the GAAP numbers, the generally accepted accounting principles, and the non-GAAP numbers they actually want us to look at are highly, highly alarming. Look at the operating income gap on this table. On a GAAP basis, it's $217.4 million, which is a 16.6% margin. Okay, but on a non-GAAP basis, they claim it's $409 million, a 30.6% margin. That is nearly double. And the diluted earnings per share? You've got 21 cents on GAAP versus 57 cents on non-GAAP. When a company asks me to just conveniently ignore that much expense, I smell financial engineering. Are they hiding severe structural damage and operational bloat in all these adjustments?
It's not structural damage at all. It's the cost of previous heavy construction. Let's unpack those hidden costs that are weighing down the GAAP numbers. The absolute biggest drag here is the amortization of acquired intangible assets from their previous acquisitions. Essentially, they are still paying off the accounting premium from old company buyouts. It's a paper loss on a spreadsheet, not actual cash leaving the bank account today. You also have restructuring charges, severance packages, legal expenses tied to old Microsemi litigation, and dividends on their Series A preferred stock. Yes, absolutely, it looks ugly on a GAAP statement, but non-GAAP strips away this historical baggage to show you the actual cash-generating power of their core, day-to-day operations. When you clear away the accounting dust, the core business engine is running at a 30.6% operating margin. That is a highly efficient, cash-producing machine.
Moving on to Section 2, looking under the hood, building the infrastructure.
So, we've verified the financials, but to really understand the strength of this company, we need to transition from the spreadsheet to the factory floor. Let's look under the hood at the actual hardware and the specific product wins that are driving Microchip's structural growth in this AI era. Remember that massive data center growth Omdia predicted? Microchip is plugging directly into that. They recently expanded their Trust Shield portfolio with the TS1800 and TS50X root of trust controllers. These are post-quantum ready security chips. Post-quantum ready? Come on. That sounds like a bunch of marketing buzzwords designed to just ride the coattails of the AI hype cycle. Why does that actually matter to the bottom line? Because data centers, critical telecommunications, and defense contractors are currently facing incredibly strict new compliance mandates. They have to upgrade their security infrastructure against future quantum computing threats, because quantum computers will eventually crack current encryption standards. By providing these specialized forward-looking controllers right now, Microchip is forging brand new, highly sticky revenue streams in high-value infrastructure. Right now, AI and data center end markets represent about 19% of their revenue. It's a rapidly growing load-bearing pillar for them.
But you know what makes Iron Financial really favor Microchip? It's that they aren't just some speculative AI play. They have a perfectly balanced, diversified portfolio. On the high-growth side, Omdia notes that Edge AI is bringing significant growth opportunities for inference AI chips and seamless device connectivity. Basically processing data at the source rather than sending it all the way to the cloud. But then on the stable foundation side, Microchip relies heavily on their NOR flash business. Unlike highly volatile DRAM and NAND memory, which suffer from these wild, unpredictable price swings, NOR flash pricing remains incredibly stable. The automotive and industrial sectors are demanding higher density memory, migrating from older nodes to 256 megabits, specifically to handle larger firmware and complex over-the-air, or OTA, updates in modern smart vehicles. This provides a steady, rock-solid industrial base that reliably funds their high-growth AI ventures.
Okay, Section 3. Cracks in the armor, the insider selling skepticism.
Look, the hardware sounds great. The non-GAAP numbers look strong. I'll give you that. But as the market skeptic, it is literally my job to find the cracks in the armor. If the foundation is so ironclad, we really need to talk about what the architect is doing behind the scenes. On April 23rd, just before these blowout earnings were released, CEO Steve Songhae dumped 416,581 shares of his own company. That is a massive stock sale worth approximately $36.9 million. I have to ask the obvious question here. If the 9-point recovery plan is working flawlessly, and the AI supercycle is supposedly going to double the company's prospects, why is the CEO cashing out nearly $37 million of his own chips? Insider selling at this scale can absolutely crush market sentiment, and it heavily signals a serious lack of faith in the building he just constructed.
I completely understand the panic. When retail investors see a multi-million-dollar insider dump, they instantly assume the absolute worst. But let's apply some basic structural engineering logic to this situation. This wasn't a panic dump in the middle of the night. This sale was executed under a Rule 10b5-1 plan. For those forging their knowledge base with us today, a 10b5-1 is a legally binding, prearranged trading plan. Executives at this level are heavily compensated in stock options rather than just a cash salary. So to buy houses, pay hefty tax bills, or simply diversify their personal portfolios, they have to sell shares. The SEC literally requires them to set up a rigid automated schedule months or sometimes even years in advance to avoid any accusations of trading on non-public, insider information, like an upcoming earnings beat. This was a scheduled pressure release valve automatically triggered by a calendar date on a computer. It was not an emergency evacuation based on internal company weakness. It does not compromise the stock's structural integrity whatsoever.
Furthermore, the CEO's own detailed commentary during the earnings call completely contradicts any bearish sentiment. Steve Songhae explicitly stated, and I quote, "We ended the fiscal year with strong momentum, reflecting disciplined execution against our 9-point recovery plan." He highlighted that macro demand conditions have fundamentally improved. Customer inventory has finally normalized across multiple geographies, and they are seeing strong expedite activity. Do you know what that means? It means customers are literally paying premium fees to rush their silicon orders because their own demand is outstripping supply. That is the sound of a company confidently laying down the next floor of their business, not running for the exits.
This brings us to Section 4, Reinforced Steel, Dividend Durability, and Future Yield.
Now let's move to the absolute ultimate stress test for any long-term retail investor. Promises, corporate guidance, and non-GAAP accounting adjustments are one thing, but the true, undeniable measure of a company's durability is the cold, hard cash it actually returns to its shareholders. Microchip initiated their quarterly cash dividends all the way back in the third quarter of fiscal 2003. Just think about the severe market weakness and systemic shocks they have survived since then. You've got the 2008 global financial crisis, massive semiconductor supply gluts, trade wars, a global pandemic, and they have maintained this unbroken timeline of payouts through it all. They just declared their latest dividend on May 7th, payable on June 5th to stockholders of record on May 22nd. An unbroken dividend history of over 2 decades isn't just a streak, it is a load-bearing pillar you can confidently build a retirement portfolio around.
Okay, I will acknowledge the consistency. That is a very long track record. They just declared a 45.5-cent per share quarterly payout, which represents a highly respectable 2.0% annualized yield based on current market prices. However, my job is to look at the math, and the math here is deeply concerning to me. According to market analysts and standard screening tools, Microchip's payout ratio is currently sitting at negative 627.59%. How on earth is a company sustaining a massive payout ratio like that without taking on dangerous levels of corporate debt or just bleeding their cash reserves dry? A negative 600% ratio looks exactly like a structural trap designed to lure in yield-chasing retail investors right before a massive, painful dividend cut.
Listen, that highly skewed payout ratio is exactly why we spent so much time dissecting the GAAP versus non-GAAP numbers earlier in this explainer. Payout ratios on automated stock screeners are traditionally calculated using GAAP net income, And as we already saw, Microchip's GAAP income was heavily dragged down by amortization and acquisition accounting noise. That resulted in artificially low GAAP earnings of just $118.8 million for the entire year. If you divide their massive dividend by that tiny paper-lost GAAP number, the math absolutely breaks and gives you that terrifying negative 600% figure. But dividends are paid with actual cash, not accounting metrics. In fiscal year 2026, Microchip returned a staggering $984.0 million to shareholders through dividends. Their adjusted non-GAAP net income, the actual cash profit they made, was $933.9 million. The cash generation is undeniably there. Nearly $1 billion returned is absolute, undeniable proof of the company's cash-generating power and financial fortitude.
And the best part is, they aren't done building yet. Looking ahead to Q1 of fiscal 2027, Microchip provided incredibly bullish guidance. They are projecting net sales between $1.442 billion and $1.469 billion. If we take the midpoint of $1.456 billion, that represents an expected 35.3% year-over-year growth and another 11% in sequential growth. They also expect non-GAAP EPS between 0.67 and 0.71 per share. They are telling the market loud and clear that the momentum isn't peaking right now. It is actually accelerating right into their seasonally stronger quarters.
Finally, Section 5, the iron financial verdict, trap, or foundation.
We have analyzed the massive macro blueprint from Omdia. We've drilled down deep into Microchip's Q4 financials, we've inspected the physical hardware, and we've rigorously stress-tested both the insider selling and the dividend yield. It is time to deliver the final, iron financial, no-nonsense verdict. Look, my final takeaway is cautious. Yes, the AI supercycle is generating massive capital right now, absolutely. But Microchip's heavy reliance on non-GAAP adjustments to show their profitability, combined with a data center exposure of only 19% and that massive multi-million-dollar insider selling, still makes me wonder if this is a potential structural trap. If the top-heavy AI demand from the 7 to 2 nanometer foundries falters, MCHP might not be immune to the broader macroeconomic fallout. And my verdict is that Microchip is exactly the ironclad foundation a portfolio needs to weather broader market weakness. They have a brilliant stress-tested balance of stable, NOR-flash industrial revenue paired with incredibly targeted, high-growth AI and post-quantum security infrastructure. 35% year-over-year growth, normalized customer inventory, and an unbroken dividend record since 2003 proves their absolute structural integrity. So we leave it to you, the investor. Are you ready to forge ahead with this momentum, or will you stay on the sidelines waiting for cracks that may never actually appear? Keep doing your heavy lifting, stay sharply focused on the numbers, and we will see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.